Awesome. Well, hello, everyone. Thank you for joining the CPMT this evening for our fourth and final fiscal quarter presentation. We'd like to give a warm welcome to the board, alumni, mentors, professionals, and attendees this evening, as well as introduce our newly recruited class of 2023 IAs. We appreciate all your ongoing support and involvement in the program, and it's a huge factor in what propels the program forward. My name is Haley, and with me presenting today is Akash, Brianna, Dhruv, Eric, Helena, Willie, and Jose. Here's our proposed agenda for the evening, and kind of as Tom said, we welcome your participation at the end. So turning to the fund's performance over the quarter, the fund returned 4.04%, which was 229 basis points below the blended benchmark. Our underperformance can be attributed to the consumer staples, utilities, and communication services sector, however, was offset by outperformance in energy and materials. A visual breakdown of the sector performance in the benchmark can be seen in the bottom right-hand corner, with month-by-month performance in the upper right. For this quarter, the fund was active in reviewing our current portfolio holdings while monitoring the shifting macroeconomic environment and COVID-19 recovery. So notably, we purchased Activision Blizzard while also trimming Aritzia to 4% AUM. So when evaluating current and future holdings, the CPMT's mandate and investment philosophy includes growing free cash flow that allows the company to pursue opportunities to enhance shareholder value, a strong balance sheet that includes working capital to fund core operations and appropriate capital structure to maximize return on capital employed, as well as income generating assets, and competitive advantage, so demonstrating clear competencies across a variety of factors against peers, as well as quality management, so assessing the control, compensation, ESG, diversity, and inclusion of the management team. So just on the following slide, in terms of benchmarks, as we see on the upper right-hand chart, the fund achieved an annualized return of 36.49%, a beta of 1.14, and a Sharpe ratio of 2.29 on a one-year basis. The CPMT achieved its performance target of 7% annualized return on a 1, 3, and 5-year basis, however, missed the 10-year mark. And the CPMT did not exceed its goal to achieve relative returns of 100 basis points on a blended benchmark on a 1, 3, 5, or 10-year basis, nor with a risk-adjusted basis against the blended benchmark. I'll now pass it off to Jose to discuss portfolio analysis.
Thank you, Haley. Just go back to the last slide quickly. Thank you. As would be expected for this quarter, we saw substantial outperformance in financials, energy, and materials names. Once again, our top two contributing holdings were Canadian Natural Resources and JP Morgan, followed by CCL Industries, Aritzia, and TD. Our bottom contributing holdings for the quarter were Costco, Apple, Intuitive Surgical, and Lululemon. For the time being, we're comfortable remaining overweight in information technologies, consumer staples, and industrials. However, our relative weightings may shift as a result of our annual pitch day that was held 5 days ago, with pending decisions on how to fund new purchases and allocate capital throughout sectors. Moving on to the next slide now. The CPMT beat the blended benchmark on fiscal quarter 2, but fell short in fiscal quarter 1, 3, and 4 throughout the year. We are happy, however, with our annual performance, given we comfortably surpassed our 7% target, albeit below the blended benchmark. The fund saw an overall negative selection and allocation effect of negative 151 basis points and negative 78 basis points, respectively, for the quarter. The overall negative selection effect may be mainly attributed to the communication services, consumer staples, industrials, and energy and financial sectors, but was partially offset by strong alpha generation in the material sector. The negative allocation effect may be mostly attributed to the consumer staples and financial sectors, but has been also partially offset by substantial gains in materials. This combination constitutes a negative alpha of negative 229 basis points for the quarter. The portfolio did achieve a higher 3-year Sharpe ratio versus the blended benchmark, but fell short on a 5- and 10-year basis. Now I'll pass it on to Dhruv and Eric to talk about Brookfield Renewable Partners.
Thanks, Jose. Brookfield Renewable Partners, or BEP, formerly Brookfield Energy Partners, is a renewable electricity generation owner and operator. It operates one of the world's largest renewable energy platforms and is the only pure-play renewable energy company in North America. BEP has demonstrated considerable benchmark outperformance with a 3-year return of 260% and a beta of 0.66 versus the blended benchmark of 142%. The chart in the bottom left shows how the majority of its exposure is in North America, but it is expanding globally, notably in Latin America and Asia. In the bottom right, we see its generation by segment. Notably, most of their generation is in hydroelectric, which trades at a premium, but also in other segments, including solar, wind, and energy transition. These assets are spread around the world and diversify BEP's asset base, both geographically and by generation technology. Moving on to its segment overview, BEP's generation capacity can be further broken down into energy storage, distributed generation, and a small amount of biofuel and cogeneration. BEP employs a unique long-term strategy that targets 12 to 15% returns to shareholders on invested capital and long-term recurring contract revenues. This is exemplified by its average power purchase agreement or PPA term of 14 years, 84% of which is contracted. This includes over 600 high-quality counterparties that are primarily comprised of public power authorities and utilities. This diversification creates downside protection that is not available to most of its peers. These investments focus on complex or large-scale transactions with improved cash flow and de-risked investments through sustainable operating principles, allowing BEP to operate as a sustainable sponsor of its generation facilities. Now we'll move on to discussing decarbonization.
Thank you, Eric. Decarbonization is a global objective, and there is still a long path to meet carbon-free targets globally. 2020 saw increasing momentum among some of the largest carbon-emitting governments to adopt ambitious climate plans and targets. For instance, Canada committed to reduce emissions by 30% below 2005 levels by 2030 and is legislating to raise the carbon tax to $170 by 2030. The United States is re-entering the Paris Agreement and announced plans for 100% carbon-free power by 2035. Japan and South Korea vowed to achieve net zero emissions by 2050. And there are many other countries on a similar path, with nearly 130 governments having committed to net zero targets. Decarbonization will require the whole economy transition, which creates the greatest commercial opportunity, with more than 100 trillion required in investment over the next 3 decades. How will this impact the industries we know today? For electricity grids, we will see renewables displacing coal and gas. In transportation, we will see electric vehicles, batteries, storage, and charging. Oil and gas will see green hydrogen production and carbon capture systems. And commodities will see green steel and ammonia. It is important to note that over 70% of global greenhouse gas emissions can be traced back to power generation and the energy sector. Moving on to LCOE. The levelized cost of energy or electricity represents the cost per kilowatt hour of building and operating a plant over an assumed life. And it indicates the relative competitiveness of different generating technologies. Key inputs in calculating LCOE include an assumed utilization rate, useful life, capital costs, as well as taxes, fuel costs, and O&M, which is operating and maintenance costs. On this chart, we can see that renewable energy sources are now competitive with conventional energy sources. So not only is there global decarbonization efforts, but the economics make sense to invest in renewable projects. However, despite the convergence in levelized cost of energy of certain renewable energy and conventional energy generation technologies, direct comparisons must take into account issues such as location, whether assets are centralized or distributed, as well as dispatch characteristics such as baseload versus those of peaking or intermittent technologies. Moving on to the next slide. Here we can see that both solar and wind levelized costs of energy have reduced significantly over the last decade, making them the cheapest source of bulk generation. During the recent recession caused by the COVID-19 pandemic, US electricity generation was down 5% and fossil fuel generation was down 10%, all the while renewable generation was up 14% in the same period. Thus, renewable technologies are becoming more economical and can compete with conventional energy sources on an unsubsidized basis. Moving on to BEP's future growth. BEP is in a prime position to take advantage of these trends and tailwinds. With a 23,000 megawatt development pipeline in the works and an increased focus on solar generation, BEP is poised for tremendous future growth. Within the renewable space, it is important to understand something called the capacity factor. So kilowatt hours and megawatt hours are measures of energy, so production or usage, while kilowatts and megawatts are measures of power, which is capacity. So fossil fuel plants are generally dispatchable, and their production is based on when the market requires them to produce, while renewable plant production is generally intermittent, thus their production is based on when fuel resources such as wind and sun are available. Therefore, the capacity factor is the number of hours a plant runs in a year divided by the number of hours in a year. BEP's capacity factor is about 31%. This seems right given BEP is a mix of hydro, wind, and solar. Due to the lower capacity factors in the renewable space within solar and wind projects, hydro assets are considered the crown jewels and are generally garnering higher multiples and valuations. With low maintenance costs, attractive margins, and the ability to store power for better pricing, that's why hydro assets are considered really, really good. BEP's robust hydro portfolio sets it apart from other renewable companies and is a distinct competitive advantage. Moving on to valuation. We take a sum of the parts valuation approach due to the different assets within the BEP portfolio. A 22.6 times the weighted EV/EBITDA multiple was applied. That resulted in a $51 target price with an implied upside of greater than 20%. There has been a recent contraction in BEP's multiple, and the CPMT finds the valuation attractive given BEP's diversified and high quality cash flows through long-term contracts, and the majority of them of which are contracted within PPAs. I will now pass it back to Eric.
Thanks, Drew. So BEP saw some changes in its management recently. Most notably, Sachin Shah was recently promoted from CEO to vice chair of BEP and managing partner and CIO of BAM. He joined in 2002 and has a BCom from U of T and a CPA designation. Connor Teskey replaced his position and was promoted to CEO from CIO and has extensive experience in corporate debt origination. According to the company, he has been instrumental in developing and implementing the business growth strategy. The diagram in the top right outlines the corporate structure of Brookfield Asset Management, or BAM. This highlights the complex corporate structure of BAM and how it currently owns 48% of Brookfield Renewables. Brookfield's corporate structure enables a complex network of asset managers to promote high achievers between companies and efficiently operate an incredibly wide asset base. Additionally, the company's affiliation with BAM allows for investment opportunities that may not be available to its competitors. Moving on to ESG, Brookfield Energy Partners, or Renewable Partners, is a leader in ESG, most notably through its contribution in accelerating the decarbonization of global electricity grids through the portfolio. Brookfield Renewables furthers its impact in partnering with institutions to help them decarbonize. The energy contracts they make with companies effectively avoid the carbon emissions that would be associated with other sources of power. So for instance, BEP provides 96% of JP Morgan's New York office electricity and has similar partnerships with multiple other large organizations. In total, the amount of carbon BEP helps avoid annually is equivalent to 12 million vehicles, 1 billion trees planted, or 2 times London, England's annual emissions. Socially, BEP maintains a social license to operate in its communities and continues to do this through partnerships and programs that give back directly to those communities. Moving on to its financials, BEP is a strong operator that trades at a relatively low valuation. It maintains a price to book ratio that is in line with its peers, and on an EV/EBITDA basis trades nearly directly in line with TransAlta Renewables and Energex Renewables. Furthermore, BEP has the strongest credit rating out of its peers, an investment grade BBB+ as rated by Standard & Poor's. BEP's EBITDA margin is also strong, slightly below its peers at 51.2% as of last quarter. Now moving up to the next slide, BEP exhibits excellent free cash flow, demonstrated in the chart in the top left, growing over the past 5 years at a CAGR of 33%. Additionally, it consistently returns capitals to shareholders through its distributions. These have grown at a CAGR of 6% over the last 20 years, in line with management's target of a 5 to 9% growth rate annually. Furthermore, BEP maintains a healthy level of debt with a net debt to EBITDA of 9.4 times and the lowest interest coverage ratio it has seen in the last 4 years at 2 times. Furthermore, 85% of its long-term debt is structured on an investment grade basis with no financial maintenance covenants. This allows it to maintain high levels of leverage and a long-term project strategy without spending undue resources on ensuring debt covenants are met. Moving on to the investment recommendation. Our investment thesis is that BEP is in an industry with favorable tailwinds and with increasing institutional investment, positive political pressures, and a growing total addressable market. BEP demonstrates best-in-class acquisitions that have been accretive to shareholders on an FFO per share basis. And as one of the largest players, BEP can use its superior access to capital to absorb smaller peers. BEP is also well positioned to take advantage of new technologies, including the new partnership with Plug Power to produce green hydrogen. It has a robust hydro portfolio with perpetual assets, strong margins, and storage capacity that allow it to capture better pricing. Finally, it has demonstrated itself as a highly capable operator with significant development expertise. Some risks of BEP include counterparty risk associated with its long-term contracts, management agency risk due to BAM's corporate structure, and the competitiveness of the renewable energy industry. In summary, the company offers unparalleled diversification within the renewable industry, and while its assets justify a premium, it trades in line with its peers. Its size advantage and management expertise make BEP the best name in our investment universe to take advantage of the energy transition. Therefore, we contemplate a price target of $51 and recommend a buy action on Brookfield Renewable Partners. Now I'll pass on to Helena, Brianna, and Akash to talk about Comcast.
Awesome, thanks, Eric. Myself, Helena, and Akash will be presenting on Comcast, which we looked into this quarter as a group. We knew we wanted something in the telecommunications sector as we were looking for something to swap with TELUS. And while we were intrigued by Disney, its performance since the pandemic and its current valuation were not attractive to us. So we decided on Comcast. Moving to the next slide. Comcast is a media and technology company that was founded in 1963 and operates internationally. You can see in the graph on the bottom right that operations do occur mainly in the US, but it is expanding. So Comcast reports revenues through three main segments: cable communications, NBC Universal, and Sky. The NBC Universal segment was acquired throughout the years of 2011 to 2013, and the Sky segment was more recently acquired in 2018. Comcast also owns the Philadelphia Flyers and the Wells Fargo Center Arena in Philadelphia. Peacock is a new development which launched across the US in 2020 and is Comcast's sort of try towards streaming. So if you're already a customer through their Xfinity platforms, you would have gotten early access to Peacock and can actually get it for free. But if you're not a customer, you need to pay around $4.99 a month. As for trading, we can see that Comcast has outperformed the blended benchmark for some time, but has really taken off since July. And on the bottom, you can see that cable communications segment contributes to revenue the most. And this is something we'll touch on throughout our presentation, as it's a huge competitive advantage to the company due to the intensive coverage they have. You can also see the Sky acquisition has really contributed to Comcast's revenue throughout Europe. Moving to the next slide, we wanted to break down each of the segments further. So we're starting with the cable communications segment, which, like I said, accounts for the largest part of the company's revenue. It feed internet, voice, video, wireless, and security and automation services throughout the US and has bundling capabilities. You can see in the graph on the bottom right to actually see how many customers do take advantage of that bundling. This segment had 33.1 million customer relationships as of December 31st. And the map in the top right corner shows the broad coverage or the cable communications distribution footprint. So like I said earlier, the segment is a huge competitive advantage for Comcast, which research actually refers to as unique, because Comcast has the largest fixed broadband service in the US, which covers around 36% of the nation, in comparison with the next closest peer, which is Charter Communications, covering around 34%. Many other peers' fiber buildouts have been much slower, such as AT&T, which is why this has essentially afforded Comcast this kind of competitive advantage. Into the breakdown of what we can see that actually goes into the revenue here and a breakdown of the customer relationships, this space can be fairly competitive, so heavy bundling can be difficult, but we can see some strong growth in the one product customers for Comcast. Moving to the NBC Universal segment on the next slide. The segment is comprised of a lot of features, and soon it will slightly change how they report to have the Peacock segment bundled with the broadcast TV and cable networks sub-segments you can see in the donuts below. So NBC Universal is a leading media and entertainment company that develops, produces, and distributes entertainment, news and information, sports, and other content internationally. It also owns and operates theme parks worldwide. You can see in the bottom left the breakdown of revenue to see what makes up the segment, and then you can also see the sub-segments in all the donuts. So cable includes national networks with offerings like entertainment, news and information, sports, international cable networks, and cable TV studio productions, and the largest portion of revenue there is distribution. Then there's broadcast TV, and this is interesting as the main driver of revenue is actually advertising and money that advertisers will be paid to be featured on these channels. And this is made up of NBC and Telemundo networks throughout all 50 states. Then we have filmed entertainment, which, like the name suggests, is things like movies. However, a main source of revenue here is actually content licensing, but the theatrical section of the filmed entertainment subsegment did decrease substantially year over year due to COVID. Finally, there are theme parks. Revenue is mainly generated from guest spending at theme parks, so things like tickets and in-park spending on food and merchandise. Currently, Comcast has theme parks in the US and one in Japan, and is working on building one in Beijing. And this subsegment, of course, has been impacted due to COVID, but is anticipated to recover quite well once travel restrictions are lifted. Moving into the next slide, we finally have the Sky segment and the newest kind of really big addition to Comcast. So the acquisition was a pretty tight race between Comcast and Fox, given that Fox already owned a large part of Sky. However, Comcast outbid Fox, luckily, because this is a pretty good segment to own. So Sky operates in 6 territories throughout Europe and is one of the leading entertainment companies throughout the region. Sky has quite a few offerings, things like entertainment, news, sports, and movies. And additionally, it has high-speed internet, voice, and wireless phone service in selected countries. And these all, again, can be purchased in bundles. So as I said, this acquisition went through in 2018, and it was the main aim for Comcast was helping to expand its international customer base. And so we in research both are quite bullish on the Sky acquisition because it really helps Comcast move out of just the US and was almost able to test things out with a more established business. Overall revenue is driven by direct to consumer, which is things like video service through broadband connections. And we can see that relationships did decline a bit in 2020. And there wasn't too much commentary on this, but through further research, I found that a lot of sporting events were actually canceled throughout Europe, which may have deterred customers from subscribing. I'll pass it off to Helena to continue.
Thanks, Brianna. Next, we'll go over Comcast financial performance and mandate fit. As you can see on the top of this slide, revenue has grown at a 7% CAGR over the last 5 years, and similarly, EBITDA has grown at a 6% CAGR. From 2019 to 2020, EBITDA did fall 10%, which was primarily driven by the significant decline seen in the theme parks and filmed entertainment segments. However, in contrast, the cable communication segment, which makes up about 75% of Comcast EBITDA, actually grew 9% year over year in 2020, which was primarily due to strong broadband net additions. On the bottom left, you can see that Comcast has historically had consistently higher margins compared to its media conglomerate peers, Disney and Viacom. Comcast has also had more consistent margins over time without the significant margin compression which Disney faced over the last 2 years. And these elevated margins are primarily due to Comcast's high margin cable business. The cable communications segment has EBITDA margins of about 42%, which is what brings Comcast's overall EBITDA margin to 31%. Compared to Comcast's primary cable peer, which is Charter Communications, not shown on this chart here, Charter has margins of about 37%. So this is above Comcast as a whole, but below Comcast's comparable cable segment. And lastly, on the bottom right, Comcast has a slightly lower return on capital compared to its media conglomerate peers, but this return has been more stable over time, especially over the past year, which is due to Comcast's more resilient combination of businesses and segments. On the next slide, we wanted to evaluate Comcast's historical free cash flow and potential for future free cash flow growth along with its capital allocation strategies. The top left shows that free cash flow has grown at a 5% CAGR over the last 10 years. Going forward, we do believe that Comcast has the catalyst needed to sustain this growth, which comes from firstly, the recovery of the NBC Universal theme parks and filmed entertainment segments over 2021 as vaccine rollouts continue. And secondly, we also expect continued growth and robust free cash flow generation from Comcast's cable business. Looking at the top right, you can see that Comcast's broadband net additions over time have remained steadily high, especially in 2020, which saw record net broadband additions of 1.97 million. And for context, broadband refers to high-speed internet. So Comcast does expect this growth momentum to continue over the next few years, which will be a driver of free cash flow for the company as a whole. And these broadband net additions are also expected to offset TV subscription losses, which have been driven by cord cutting among customers. The bottom left chart shows Comcast capital intensity. And going forward, one of management's priorities is to expand margins and lower capital intensity in the cable segment, while still investing enough to maintain Comcast network speed and capacity. And this shift towards higher margin broadband customers over traditional lower margin TV subscriptions is another factor that will support this margin expansion. And lastly, on the bottom right, Comcast does return any excess free cash flow to shareholders through both dividends and share repurchases. Management has increased dividends for 13 consecutive years, paying $4.1 billion in dividends in 2020. Share repurchases were paused in 2019 to be able to allocate more capital towards deleveraging efforts following the $40 billion acquisition of Sky in late 2018. And over the next year, we do expect delevering to remain a priority for Comcast, while share repurchases will remain a vehicle for distribution of any excess capital. Which brings us to our next slide to take a look at Comcast's balance sheet. Comcast has $113 billion of debt, which results in a net debt to EBITDA ratio of 3.2 times, as you can see on the top right. This is below both of its media conglomerate peers as of 2020. Comcast's most significant increase in leverage occurred in 2018, and this resulted from its $40 billion acquisition of Sky. And since then, Comcast has committed to delevering to its target range of 2 to 2.5 times. As you can see on the bottom of this slide, the major credit agencies have all given Comcast an investment-grade credit rating, all with stable outlooks. And on the bottom left, you can see that S&P has consistently raised their credit rating for the company, even through Comcast's multi-billion-dollar acquisitions of NBC Universal in 2011 and 2013, and Sky in 2018. And overall, we do view Comcast's balance sheet as healthy and resilient to economic downturns, posing no major risks for the company moving forward. To finish our discussion of Comcast, I will now pass it to Akash.
Thanks, Helena. So we just wanted to touch on management here, and in particular wanted to highlight two of the notable executives at Comcast that have been vital to their success. So starting off with CEO Brian Roberts. He was the son of founder Ralph Roberts and has been with the firm since early 1980s, including a period where he held a position as an intern within the organization. Through his tenure with the firm and being president since 1990, he has seen the firm grow into a global media and technology giant within the US, growing its revenue from approximately $657 million to $104 billion by 2020. We also wanted to highlight Jeffrey Schell, the CEO of NBC Universal. During his tenure at Comcast, he oversaw years of record profit and oversaw the portfolio grow to include products, games, and live entertainment on top of its already existing content offerings. Within Universal, he also oversaw the acquisition of DreamWorks by the company and helped shape the film entertainment segment into one of the market leaders it is today. Now, looking at the top right here, we just wanted to highlight the compensation mix. A small portion of the NEO's compensation mix is fixed, while the remainder is either tied to equity or performance-based incentives, showing strong NEO alignment with shareholders and strong governance. Highlighting on the ownership structure, Brian Roberts, the CEO, owns approximately 0.75% of the common float, which is important when looking at the dual share structure they employ. While virtually all the shares in the market are Class A shares, there remains a small portion of Class B shares that are owned by the CEO. While these shares do entitle him to 15 votes per share, within the proxy filings, the company has noted that his shares only entitle him to approximately 1/3 of the total voting power of the firm. While this may look high relative to many other corporations we hold within our fund, Roberts has been with the corporation since the 80s and has been able to drastically transform the business over that period, overseeing many acquisitions that allowed it to enter into new industries, and recently with the Sky acquisition, start to enter new geographies. Under this directive, we believe that his high voting power is warranted, given his tremendous track record with the firm. Moving on to the next slide here. As Comcast is quite a diversified media giant, they operate in quite a few different industries that Brianna touched upon at the beginning of the presentation. We wanted to highlight the position in some of those. So starting on the top left here within the broadband space, Comcast has the highest total broadband and video connections to date, with only Charter and AT&T coming close behind. As cord cutting continues across the space, we believe we will see a high reliance on broadband, and management is expecting strong broadband adds across the space over the next few years as home penetration and homes passed continue to increase. Onto the cable networks on the top right here, we know this is a fairly competitive space, but we do see two of NBCU's networks being one of the most watched in the US over the last year, with NBC and MSNBC. While television viewing is still going down, these primary news channels still garner quite a bit of attention from public viewers, as opposed to more content-heavy channels. On the bottom left here, we just wanted to highlight theme parks, and it's not surprising that Disney theme parks are obviously dominant in terms of attendance, but Universal parks still fare quite well. In our view, usually when consumers go to many of these locations where there are overlapping Disney and Universal parks, they will usually attend both as opposed to just one at a time. We also believe that further expansion of the company into Beijing will give them more exposure across the globe, allowing them to further compete with Disney on the theme park side. On the streaming side, just on the bottom right here, we do know that Peacock is quite nascent and has only been around for just over a year. It lags the rest of its streaming periods, and it'll be really interesting to see over the next few years how it continues to grow compared to many of its other streaming giants, and in particular, one of its main competitors, Disney+. It is possible the firm continues to push hosting their NBC and Universal content only on Peacock, such as what they did with The Office, taking it off the US Netflix and putting it on the Peacock platform. Currently, Peacock is the cheapest among all the streaming providers, only being $4.99 per month. Additionally, what Brianna talked about earlier is all Xfinity users get it for free, again, providing a boost to subscribers numbers here. Now, onto the valuation side, we value Comcast using a 50-50 blend of a DCF and an EBITDA exit multiple. Through this, we had a WACC of 7.3%, assumed a terminal growth rate of around 2%, and an exit multiple of 10.5 times, which was in line with their historical averages. Some main factors that are built into the revenue growth was mainly based off the reopening of economies post-pandemic. Comcast has been touted as a reopening play, mainly due to its exposure to advertising, its theme park segment, filmed entertainment, and potential for further penetration in its cable segments. We believe that increased sporting events will allow for a boost in advertising revenue, which is highlighted by a new deal with the NFL that will see Super Bowl and playoff games streamed through its platforms through 2030, and obviously the Tokyo Olympics next year, along with the Winter Olympics as well, which will provide more advertising distribution revenues. On the studio side, we believe they'll begin to reopen, and production will continue, followed by the releases of some featured film that had their release dates pushed, such as Fast and Furious 9, a new Minions movie, and Boss Baby 2. On the theme park side, they are set to reopen in late April across the US, so we factored in approximately 8 months of operations this year, barring no additional restrictions are imposed, followed by consistent year-round operations through our forecast period. Lastly, on our cable communication segment, we do believe it'll continue to grow through net broadband additions as penetration of homes passed increase, and there's a heavier reliance on having sufficient infrastructure at home, especially with increased flexibility of work from home mandates for many corporations due to the pandemic. On to the next slide here. On a relative basis, Comcast has been historically trading just below Disney and slightly above Viacom, but we do believe there is potential for multiple expansion in the near term, mainly driven by its two growthy segments being NBCU and Sky. We believe the media conglomerates would be their closest peers due to similar offerings and similar sizes compared to some of the pure play broadband and broadcasters. Multiples are more in line with Viacom right now, as opposed to some of the higher growth business lines that Disney offers, which we believe that has not been priced into Comcast valuation right now, allowing us to have an attractive entry point into the name. So just moving on to our investment recommendation here, we believe that Comcast is a market leader in the communication services sector. It's well positioned to outperform over the next 3 years, with growth driven by its NBCU, Sky, and stable growth from its cable broadcasting segments. We do believe there will be many tailwinds coming from the reopening of economies and vaccine rollouts, which I spoke about a few slides ago. While cord cutting will continue to be a trend moving forward, we do think that net broadband additions will fuel the communication segment, offsetting these losses and driving stable growth. New sporting events such as the NFL and the Olympics will provide a sufficient marketing opportunity for the firm to not only gain traction on its already existing platforms, but to also increase its advertising revenue. On the Sky segment, with new soccer leagues coming back and being able to play year-round too, we do believe that there's more exposure in Europe for them as well, which would provide growth for that platform. On its balance sheet side, we do believe the balance sheet is quite strong, and we do think it will continue to deleverage further with management's stated goal of 2 to 2.5 times EBITDA, such that it will maintain investment grade ratings and be able to access the debt capital markets to get low cost financing. The company also trades well below its media conglomerate peers, mainly Disney, and is more in line with Viacom, which again may signal potential growth not being factored in right now, providing an attractive entry point. Through this, we believe that it fits all the mandate points and intend to purchase it at a 2 conviction, swapping it with our other telecommunications holding, Intellis. I will now pass it on to I'll pass on to the next person.
Yeah. Thanks, Akash. So over the quarter, Jose and I looked into Zoetis, a leading international animal health company in discovery, development, manufacturing, and commercialization of animal health medicines and vaccines. Its complementary business includes biodevices, genetics, and precision live farming. It also offers data management, e-learning, and professional consulting. The company has a portfolio of over 300 product lines across 8 core species. So its livestock species include cattle, swine, poultry, fish, and sheep, and companion animals include dogs, cats, and horses. Although the company distributes its product portfolio and complementary services internationally, its R&D teams are throughout the US, Europe, Australia, and the emerging markets. which we believe is well positioned to become experts in these markets and service unmet medical needs. So North America is the largest market by revenue of 4.8 billion, with international being 3.7 billion, with the largest international markets of China, Brazil, Australia, and the UK. So looking at the top right chart, the company has demonstrated strong holding period returns since its IPO in 2013 as it spun off from Pfizer's animal health segment. Pfizer's prior acquisitions actually built the infrastructure for Zoetis's market penetration and leadership into livestock and companion animals, which influenced a strong runway for growth that we've seen to date. And since the IPO, the company is specifically focused on diagnostics and biodevice acquisitions. Its drug rollouts in the companion animal segment, which represent roughly 20 to 30% year-over-year growth, and value-added technologies to aid farmers and vets, such as vet scan images, precision line farming, and genetic therapies. So just turning into the broader animal health industry on the following slide, the industry represents a global market of roughly 40 billion and is estimated to reach roughly 70 billion by 2026. The animal health portfolio products can be segmented into traditional and expanding. Traditional includes vaccines, pharmaceuticals, medicated feed additives, and parasitides. These help to keep animals healthy as possible, improve life expectancy, and prevent disease. So since all animals need this, it represents a steadily growth around 4 to 6% year over year. The expanding segment includes diagnostics. So Zoetis has a diagnostics portfolio that consists of more than 90 instruments and tests for vets to monitor and detect disease, which reduces times from traditional methods for diagnosis, as well as genetic solutions that provide genetic predictions and optimize profitability and yield, as well as precision live farming, which is actually unique to Zoetis, and it's an on-farm digital platform focused on disease prevention and transparency for consumers that are interested in how food processing animals are raised. The key industry drivers include government initiatives to encourage growth for veterinary products and treatments, further supporting food security measures. So according to the UN, the global population is anticipated to reach roughly 9.7 billion by 2050. So policymakers are increasingly striving to achieve total food security, sustainability, prevent foodborne illness, and have healthier offspring. So it's triggering companies to produce advanced vaccines and pharmaceuticals. There's also an increased adoption in pet animals as increased discretionary income increases in emerging markets, and animals have become a pivotal member of families as well as beneficial to mental health. There's also increasing technological advancements that include information management systems, animal owner mobile technology, and vaccine banks that aid in facilitating real-time analysis of disease. And finally, diseases in animal health also affect human health. So vaccines are actually increasingly important, and regular animal healthcare checkups of these diseases are often easier and more effective than doing so in humans, country dependent, of course. So just moving to the following slide, Zoetis's continuum of care model centers around predict, prevent, detect, and treat. So as I alluded to before, it has a breadth of pipeline drugs that it's developed and acquired over the years. It has roughly over 1,100 new products and innovations in the last 5 years, and R&D and acquisitions specifically have allowed the company to make drugs easier for use for the end client, such as 2-in-1 or 3-in-1, as well as obtain first approval in its largest markets, including the US, Australia, New Zealand, and China. The company has also developed 13 blockbuster products in its portfolio that earn over 100 million revenue annually, as well as top 10 products that account for over 40% of total revenue. The portfolio is also quite durable with a market life of roughly 29 years. And the company's vision and strategy is what enables its competitive advantage in the animal health space. It's such as its innovation and growth. So developing one-of-a-kind drugs, such as its newly marketed Simparica Trio drug, which is a triple combination treatment for fleas, ticks, heartworm and disease, and gastrointestinal parasites in dogs. So this is quite a common issue, and it's actually attributed to the companion animal segment of roughly 20 to 30% growth. It also specializes in its customer experience, its data-driven analytics, as I mentioned before, and sustainability efforts. So it's actually one of the first animal health companies to create and enforce ESG metrics into its business model. I'll now pass it off to Jose to discuss the rest of our analysis.
Thank you, Haley. Because of the global nature of the company, it is quite hard to specifically find direct comparable companies for Zoetis, even if there are various distributed animal pharmaceutical players across the globe. Zoetis benchmarks itself with the pharmaceutical index, which is why we decided to add giant pharma peers Eli Lilly and Merck for peer comparisons, and these pharma peer bars are colored forest green in the slide charts. We consider Elanco to be the only real animal health peer for Zoetis, given that it is the only other large cap animal pharmaceutical company. Elanco manufactures and markets products for pets and farm animals with very similar subsegments to Zoetis, including pet health, disease prevention, and detection, and therapeutics. The company also has a sizable farm animal subsegments. Elanco actually acquired Bayer AG's animal health business in 2019, becoming a substantial player in the industry market. However, Zoetis is still a $70 billion market cap company versus Elanco at $13 billion market cap at the moment. This company also benchmarks itself versus pharmaceutical companies and is also colored forest green. We decided to also include small cap international companies such as French animal pharmaceuticals, Betocquenol, and Virbac, as they are significant players in the European space and have comparable products with Zoetis. These peers are colored gray. Lastly, we also decided to benchmark Zoetis against established veterinary technology peers, Covetrus and IDEXX Labs. Covetrus is a provider of veterinary supply chain services, veterinary software practice management solutions, marketing and payment solutions, and prescription management technologies for practitioners and veterinary distributors. On the other hand, IDEXX Laboratories develops, manufactures, and distributes diagnostic devices, testing technology, and instrumentation for various modalities used to manage and track animal health. The company's business segments include the companion animal group, the water quality group, and the livestock, poultry, and dairy group. IDEXX and Covetrus are referred to as animal health tech peers and are colored turquoise. As you can see from the chart on the left, Zoetis is best-in-class EBITDA margins amongst all comparables, which we believe is an indicator of the company's strong cash flow generation capacity. Additionally, as you can see from the bottom right chart, Zoetis is really strong EBITDA growth to peers as well. This must also be taken into the context that Zoetis is 40 times bigger than Virbac and has a much bigger base to grow from, which is remarkable. We are encouraged to see that Zoetis is investing aggressively in its diagnostics, genetics, and technology business. As we can see that IDEXX Labs, which is a company that solely focuses on that, has performed very well with little competition in that animal health subsegment. Moving on to the next slide to mandate fit. We'll first take a look into the competitive advantages mandate point. First, the CPMT is very attracted to Zoetis' product portfolio breadth across the continuum of animal care. This allows the company to balance its R&D efforts within subsegments of the animal health market where it sees more upside or technology adoption. Although nearly 41% of the company's total revenue is sourced from 10 products, the company has nearly 300 products in the market. Second, sustained innovation momentum. Given that the company, going back to the company's ability to see market trends before other competitors, Zoetis' efficient capital allocation turned to frugal R&D is showcased by their companion animal segment growth. The segment grew 30% year on year in 2020 due to the mix of the Simparica Trio launch, which was mentioned by Haley, and its innovation in pet dermatology. Third, Zoetis' main competitors are large pharmaceutical companies with animal health subsidiaries, animal technology focused companies, or international small cap animal health biotechnology companies, rendering Zoetis pretty much as a pure play leader within the industry with global foothold in every single segment that they operate in. And lastly, best-in-class products that are first to market pose incremental growth opportunities for the company in the long term. Onto the quality management mandate point, I wanted to show the capital return to shareholders over time at the top right as a proxy for management's shareholder centeredness. Zoetis has returned almost $4 billion of capital to shareholders from 2013 to 2019, and NEO's pay is 75% at risk, while CEO's pay is 91% at risk. Moving on to the growing free cash flow mandate point, the company has seen a 21.1 7-year free cash flow CAGR, which along with best-in-class EBITDA margins encourages the fund on the company's ability to continue to deliver on this trajectory. Lastly, regarding the healthy balance sheet mandate point, the company has been able to lower its net debt to EBITDA ratio from 2.4 times in 2015 to 1.48 times in 2020, even through a considerable stint of acquisitions. Zoetis has also been able to grow its interest coverage ratio from 6 times to 11 times in 2020. And along with $3.5 billion in cash and $2.5 billion in available revolver capacity, we believe the company has a considerably strong balance sheet. Now moving on to the last slide. As you can see, Zoetis does trade at a premium to pharma peers with the exception of Elanco, but trades at a considerable discount to animal health tech peers. The CPMT believes the appeal of this investment is getting exposure to a growing animal health market. Although we're not expecting the pharmaceutical livestock segment to grow dramatically in the coming years, We expect Zoetis to continue to execute on companion animal growth trends and continue to build its diagnostics, genetics, and biodevices portfolio through R&D and tuck-in acquisitions. Seeing IDEXX Labs' success in the animal testing and diagnostics space, we believe there's a strong opportunity for Zoetis to become a substantial player within this space in the long term as well. We consider Zoetis' livestock segment to be a cash flow generation machine, which will continue to fund effective R&D efforts in growth markets. Although, as previously mentioned, the pharmaceutical livestock segment is not the main part or main appeal of this investment thesis. Given the strong mandate fit, we recommend to buy on the stock. Now I will pass it on to Helena to talk about the year in review.
Thanks, Jose. Although the pandemic has forced our operations to shift to online, we were still able to operate efficiently, shifting many of our activities and responsibilities to new platforms. One of the few benefits of shifting to an online environment has been our increased ability to communicate with many of our alumni from across the globe, as shown on this page. We are able to access alumni from not only Calgary and the usual places that we usually see, but also be able to access alumni from Toronto, across Canada, and even within Europe. We wanted to take this time to sincerely thank all of the individuals who have provided their time and efforts towards the mentorship of our current classes, as well as hosting speaker series for the fund over the course of the year. While we were unable to meet with you guys face to face, we were still able to absorb the valuable insights and information you continue to provide to us. As we move into the coming year and our PM class leaves, we do believe with the incoming classes, we can maintain these relationships and continue to build new ones, allowing the fund to continue functioning at its very best. That being said, the fund is continuously always looking for additional mentors and speaker series from various firms. So if this is always something of interest to you, please don't hesitate to reach out to one of our members or Tom. Moving on to the last slide here, we really wanted to highlight the success that our members have had finding careers in the industry. And a lot of this had to do with the valuable connections we have through alumni and mentors of the program. Historically, the fund is placed very well within Calgary, but with this year, we've been able to expand our reach lately with positions in Vancouver and through the US. The fund itself to many of our members has provided an invaluable learning opportunity and has allowed us to make the connection between in-class learning and real-life applications. We do hope to continue this trend of positive placements through the longevity of our fund, and all that has to do with everyone's support, especially with coming out to our quarterly events. That being said, we would like to thank everyone for attending our annual presentation, and we will now open the floor to any questions.